life's not going to wait and life will never be perfect. And we always know that the one constant in life is change. And we don't know what tomorrow's going to be. So go ahead and secure what it is that you have today, which is your health, right? The younger you are, the more vibrant you are, the more likely you'll get approved. Lock that in because, again, tomorrow's, and we'll get into that personal story of mine a little bit later, but tomorrow's not promised. Welcome to another episode of Wealth Wise Banking. I'm Jeremy Lee Huggins, and I'm here today with my co-host, Jason Sipple. How's it going, man?
It's going fantastic, man. You always gotta say fantastic 'cause it hacks your brain and it forces you to smile, even if you're having a bad day. So, but things are going outstanding, man. All winning down here.
Good, good. Yeah, so we got a really good episode today. This episode was actually inspired by a conversation I had with someone at a workshop I was at last week. So I was at a 2-day wealth workshop. I was one of the keynote speakers at that. And at the end of it, she came to me and said, "Hey, Jeremy, I really like everything you're talking about. However, in my life right now, I'm in a transition period. I've got debt. I'm taking care of my parents, right? Cash flow is a little bit tight. How can I actually implement this system with where I am today?" And as I got to thinking about it, she's not alone because there are people with debts. People have kids. People have business expenses and cash flow kind of gets tight at certain, stages of life. And when you start implementing one of these whole life products, it can look daunting, right? It may feel as though it's a cost. And until you actually start implementing it in your life, you're building that cash value, your understanding it's both an asset upfront, it can feel heavy, especially in a very juvenile policy, one that's just now getting off the track. So this episode today is meant to discuss that. How can you actually get started today, even when cash flow is tight, even when you're in a transition period of life? So that's what we wanted to discuss today.
I love it, man, and it's a powerful episode because I know we brought this up a while ago when I was at the last think tank, and I was sitting around people who have been helping people, serving people to do this for the last 30 plus years. When I asked them what's the one thing they wish they did more of, and this is based on their clients' feedback, it was to help them with what we're going to talk about today. Like
Yeah.
this was the answer they gave, which I was shocked. So I did a lot of digging into it, wondering why they would say that. And then the more people you help, the more time someone's I won't give away the punchlines, but the more that someone isn't able to get what they need when they actually have the money to do it, you got to make sure that you open that door now so you can protect your ability to build it later, right?
Yeah. Yeah. Because a lot of folks will hear, infinite banking and they want to get started. They want to get started, but again, they may have to overcome some debts, some financial, issues. Our parents are aging. A lot of us are finding ourselves helping our aging parents. We have kids that are in school. So how do you get started? There's really three different core groups of people that we're going to be talking about today. So stick with us through the entire episode. We'll go through three specific scenarios. I'll give a relatable story on how this actually hit my family. It was close to home.
Hmm.
So we'll go ahead and start the process now. Jason, when someone comes in and they say, "Hey, I really like infinite banking, but I'm having some issues with the funding mechanism of it." How do you address that specific concern up front, right? What is an alternative that will bridge the gap between where they are today and where they can be tomorrow when that cash flow opens up?
Yeah, it's a great question. And the first thing, Jeremy, is you got to get really clear on every dollar that's coming in and every dollar that's going out and where it's being assigned. Like, what is the job of that money? But you're asking me like, how do we help someone because they're coming in saying, "Hey, I see the power of privatizing my banking system, right? Creating a family bank system, but I don't think my money's, I'm not going to have cash flow based on scaling the business or based on the debts we have that we're going to pay off and or maybe my kid is going to be out of college and I'm no longer paying X amount per year to help them get through college. They're going to be on their own, they're going to have a job, right? Whatever that time period is, there's a bridge to gap. That's kind of what you're asking me, right?
Yeah.
Like
Yeah.
how do we bridge the gap from today when they're insurable, because we've already figured out they're insurable, to the day they actually want to start this.
Yeah, yeah. So there's a specific product that we like to use, and I like to call it a bridge policy for that reason, right? It's not a banking policy, it's a bridge. That's exactly what it is. It's a bridge.
And it's the convertible term, right? That's what we're talking about.
Yeah.
So It's term insurance. It's not a family bank system, but that convertible term is going to give someone a way to start this before they're ready for the full structure.
Oh my goodness, you said term. You sound like Daddy Dave right now.
Hey, he's my best friend, man. Me and Daddy Dave, we go way back. Yeah. He knows about this stuff.
Yeah, so the power of convertible term could be for someone who's young, right? Or someone like to Jason's point, they may be paying off some debts and they haven't necessarily instituted the banking practice of helping the policy to pay down some of those debts. Or they could be early in their career, or like the person that I spoke with last week, she just left New York City. She had a multi six-figure job, but she decided to venture out and become an entrepreneur and create her own leadership and coaching course. And she was saying, hey, I'm in this transition period of life right now, and I'm just now getting my business up and running. How can I implement what it is that you're doing? And I want to start, but I also have a history of family health things. So how do I protect that? Well, my answer to her was convertible term, right? We'll put in a bridge policy. What that is and what term is specifically is exactly what it sounds. It's a specific term for life insurance. The power of it is that when it's built for conversions, you can actually lock in your health rating today. And for a specific period of time, typically 10 years or more, you have the opportunity to now convert it either in full or in portions to a whole life product. The whole life product, not traditional whole life. No, no. It's a banking policy. It's one designed for maximum cash value, one that's going to build equity, and one that will actually have a higher protection piece the moment that you implement it. So that's what we do. We implement convertible term for some folks who are in that transition period.
And it can work. We'll give some other examples too. But if you're listening, when you're listening to this, is there a moment where you've been waiting to do the perfect version of what you thought it was, and then you're actually doing nothing in the meantime?
Yeah, analysis paralysis.
Yeah, imperfectly perfect is how we like to move forward. If you don't know it, just say, "Hey, I don't know it yet." Give yourself permission.
Yeah, and that matters, right? Because life's not going to wait, and life will never be perfect. And we always know that the one constant in life is change, and we don't know what tomorrow's going to be. So go ahead and secure what it is that you have today, which is your health, right? The younger you are, the more vibrant you are, the more likely you'll get approved. Lock that in, because again, tomorrow's, and we'll get into that personal story of mine a little bit later, but tomorrow's not promised. We actually had a guest speaker. You remember we had our pilot that was on, and
I do. Just
he
connected.
had his insurability taken away from him. All right. He was not able to implement this practice anymore because his health changed literally overnight.
Yeah, I've got several stories with that same scenario where someone was approved, had a health change, and then now is not approved, right? So nothing was locked in. Actually, mistake there was no cash on app, so he wasn't protected already, like when he had it, and then had that protection if something did happen. Um, but I had another one the other day where someone is now, because they're going through transition at a young age. This is the next one we're getting to. A young builder is they might not be able to, they see the power, they're saving money now, but they're still in the early stages of their career of adding value, of making themselves more valuable so they can earn more money, Jeremy. And when they have a transition at a young age, something like a premium deposit might seem a little bit of a burden, right?
Mhm.
So what could they do? Like I just had someone tell me, "Hey, I think I need to surrender my policy because I'm changing careers and I need to get all the cash value out of it." And look in retrospect, looking back 3 years ago, I think we're going to be able to help her get through this. But I would have said, "Hey, this would have been someone for this episode where we could have locked it in and had enough to convert at a later period."
Yeah. Yeah. No, absolutely. And I don't want to go down that rabbit hole, but I already came up with a couple of answers for her situation specifically. But staying on course, you did mention the typical person. So we talked about the first avatar, which is basically the person in transition, a transition phase of life where convertible term applies, where convertible term probably makes more sense than a traditional banking policy. The second one, you mentioned a young person. And this one, directly applies to someone who's on my team. Artem is just graduated college this past weekend, and he's not making a lot of money in college, right? Like he has to go to school. He's more or less part-time working with me. And what he ended up doing, such a smart young man, went through and created his own convertible term policy because he wanted to lock in the ability over the next 10 years to take advantage of his young premium preferred health rating so he can maximize the benefits of his banking system, right? So this is a guy who's literally already teaching this system, went through, put himself on his own convertible term because he was in college. Not only was he in college, he was also an athlete in school, right? So he was playing hockey. So for people who want to access cash value someday for opportunities, emergencies, right, long-term control, this is also a good bridge. This is a good starting point for him to begin. Convertible term is a good place for him to begin. So as he increases his income, as he takes on this full-time position, he can actually start converting that in pieces or in whole into a permanent system.
Hmm. Yeah. And just curious, did he max out his system? Did he go that far to max out what his insurability was at this point? Because when you're young too, that's another thing. You can carry a lot more insurance if you're making the same amount of money that you're going to make over a period of years, right? So,
Yeah, and he did, right? But there's also an income factor when you get these things. The intention is he maxed it out right now, but as he continues to, develop his real estate portfolio, create, keep, and multiply, expand his net worth, he's going to be able to expand that system even more. This is basically more or less his starting point. It's where he's beginning, not where he's ending. The fact that he has such a long-term vision and he sees how this whole thing is going to map out for him, he knows where he's going to be on what phase of his journey. And he's like, hey, this is where I am today. Like I'm a full-time student, I'm playing hockey, and I know that this is important. I want to lock in my ability to make these conversions over time. So he did it at a price point where it's really affordable for him and locking in future predictability, future control. That's what he did. He created certainty in his life by implementing this.
yeah, which is very different from someone saying, "Hey, I'll deal with it someday," right? Artem's like, "No, I'm gonna take care of it today. I'm gonna build for the future. I know where I'm going and I know what I'm gonna need," which is long-term thinking. That is one of the biggest switches we're helping our borrowers become builders, right? So,
Yep, absolutely. All right. So what does that mean when we talk about locking in insurability? Like what does that mean, Jason?
this, well, again, we've talked about a couple of cases already. The health is an asset that people are taking advantage of, especially guys. Like I've noticed, Jeremy, that we think we're going to be invincible forever. And this is where it gets personal. Like why does locking in insurability matter so much?
Well, it really matters because we may not have as much time as we think we do. Like to your point, right? People are healthy today. We're typically healthy while we're younger, and we can qualify today. Like that's probably the biggest point of contention is this is not something you can just go purchase, right? This is not just a regular real estate deal. It's not an asset like a Roth or something that you can go and purchase. There is a qualification period. And as much as I think that everyone should have this asset class, not everyone qualifies for the asset class. So the ability to start while you're healthy, the younger you are, the better your chances, right? But to your point, life changes and you can get a diagnosis, you can get heart disease, medication. Maybe it's a family, like in my family, diabetes. Like my father has it, my two of my sisters, my grandmother.
Hmm.
Diabetes is pretty prevalent in my family. So having convertible term on me makes sense, right? As I continue to grow and expand my system. Um, where this really hits home, my personal story is with my mother. My mother had term insurance. My mother ended up getting a brain tumor. My mother did not have the ability to convert her term into permanent insurance. And after the brain tumor, I had to fight for over a year to actually get her permanent insurance. But based on that health rating, it wasn't at the rating as though we wanted it. So I was still able to design something permanent. I had to fight for it. So if you do have a health scare, a diagnosis, I don't want you to self-eliminate. The fact that I was able to get my mother insured and get her a permanent policy after a brain tumor is a
Hmm.
testament that we will fight for you. We'll probably fight harder than you will and keep going until you say no. But the where this hits home is the fact that she did not have the ability to convert when she had that brain tumor, when she had that diagnosis. So she lost that ability because of the way that it was structured. To that point, not all term insurance is convertible.
Yeah, that's a powerful point. Like you hear what Daddy Dave is saying. all the time. I don't know if he's really giving people convertible term the way he thinks about whole life. What do you think, Jeremy? I don't know for sure. I just thought about it just now. It's popped into my brain, but I'm guessing that's not what he's talking about.
No, he's looking at a systemic issue and solving it with a temporary band-aid. That's what he's doing.
Yeah. Yeah. Instead of going back to what our grandparents believed right before 1985, where whole life was really prevalent. And
Mhm.
now we're just saying, hey, at some point you're going to want this. And as we're sharing, right, with your mom, with other people, our clients, with people that we work with yourself, when you know you like, there's a lot of, I mean, we're dealing with cancer stuff in my family again, right? So that's like I went and did my blood test again today, Jeremy. And then, I carry a fair amount of convertible term on my body for the way I design my policies. So part of the special engineering can have convertible term in them as well that I'll convert later and lock in my insurability. But to that point, I could probably look at getting more based on what we're talking about, right? But based on change is inevitable, it's going to happen. And we need to protect now to prepare for the future.
Yeah, you're guaranteeing basically future results. You're preserving choice. You're preserving control before someone can take it away from you. That's what we're really doing with convertible term. Again, it's nothing more than a bridge. It's not the end goal. It's not the destination, but it is helpful along the way. So far we've discussed convertible term being really good for two people. We discussed people being good for in a
Transitions.
transition period.
Yep.
We discussed it being good for the young builder, right? The person who's
Yep.
just now starting out in their career. The third person so the third person is someone that I've worked with a lot, especially some high net worth individuals that want a protection gap. So what does that mean? A protection gap. So when someone wants to have they already have a high cash value policy,
Hmm.
but where does term fit in for that? How do you structure that, Jason?
I mean, this is locking in like if they're high earners, right? When they're high earners and they're already have a specially engineered policy that prioritizes cash and they can use it for the banking needs in their life. They also your health isn't guaranteed, Jeremy. So if they can lock in an extra, like I got a fourth avatar for you after this, but it's similar to this person that we're talking about because she is a high earner. She does have a policy already, but there was a reason for her that need extra death benefit, and we put another $1 million of convertible term on her body. But when you're talking
Mhm.
about protection gap, it could be protecting the business, it could be protecting their family, to cover all of the assets and liabilities that they have. It's just maximizing their death benefit that's going to maximize their future opportunities.
Yeah. So when Jason and I engineer these designs, a lot of them are to maximize the living benefits. So we really look at the cash value growth, right? And then we typically look at where is the death benefit at age 80, later in life, when it's most likely to be needed. To Jason's point, well, what if a family wants to come in and increase the early protection amount, right? Maybe it's a high income earner, but he's a sole breadwinner in the family. And based on current family assets, that additional protection is something that he wants, but he doesn't necessarily want the added cost in that bridge period. So what we'll do is I'll do a two policy approach. It's literally two policies at the exact same time.
Mm.
They'll go into the review process. They'll get a high cash value banking policy. And at the same time, they'll also get a convertible term policy. The banking policy is there for all the living benefits, all the cash value growth with a future long-term death benefit. And the gap in between the term is basically just purchasing literally that additional protection for a set period of time as the rest of his assets rise to meet the other expenses that he has. So we're just creating additional protection. Where else does it lie in? Well, if I'm a small business owner, perhaps I need a certain level of protection to cover my SBA loan, as an example. So we might, as a high income earner, need additional coverage, but we don't want to pay a lot for it. So what we'll do is put it on for the length of the SBA loan. We'll have it for a certain period of time while it's mandated. What's nice is if the business goes well, guess what we can do? Turn it into permanent. So we can do conversions, either partial or in full. That is the destination. That's the
Oh,
goal,
man, you're
but
taking
it's
all
not
my stuff,
necessarily,
Jeremy.
yeah,
You're
yeah, go
you're
ahead. I'm sorry, I cut you
oh,
off.
you're on a roll. I didn't mean to cut you off, but you're like everything I'm thinking of that I want to say is like, okay, so in the example of when you're building the two at once, right? You're building the banking function, the family bank. You're locking in their insurability now when they know that their going to be insured and based on what they're earning today. We call it the human life value. We've had an episode on this, like how much insurance can you carry? But you can convert the term at any point and you don't have to convert all of it. You can convert a portion of it to a special engineered banking policy and still carry the term for a longer period of time, right? Like you get to kind of mix and match what's going to be the best set. So it's really locking in more options.
Yeah, exactly. You get more future control. That's what you're doing. So that's what I like to use it for. So those are the three avatars that we more or less discussed. You mentioned a fourth one. So the first avatar is really someone in a transition period. The
Yep.
second one is someone who's a young builder just starting off in their financial journey. The third one is someone who's just looking to bridge a gap, right? They're already a high income earner. They're at a certain place in life, but they may want additional protection gap. That's what they're looking for, is basically gap insurance that
And
preserves future insurability.
the
So
fourth
your
one?
fourth one, give me a fourth
What's the
one.
fourth one? Okay. The fourth one, I mean, is more near and dear to my heart, which is why it's the bonus one. But it's going to be if you're looking to expand your family banking system to juvenile policies to your kiddos, then, if you have a certain amount, like this entrepreneur, this high earning, woman already had started her banking policy, Jeremy. She came back. She's like, I want to do this on my three kids. I was like, cool, that's easy. We can help you do this. You're going to take half of what you're paying them a year. You're going to store it in a policy and you're going to do this for all three of your kids. And so when I ran the youngest, the 2-year-old's policy and saw how much coverage they were going to have, right? How much underwriting amount, and I looked at how much she had existing in whole life, I said, "Wait, you've got almost $1 million gap. So we can either put $600,000 more convertible term on your husband so we can get the kid approved, or we can do that convertible term on you so that way you have enough coverage to justify having that much coverage on each of your kiddos."
That's funny. That's literally what we did for my nephew. So my nephew, we replaced his 529 plan with a banking policy, but my sister had to be insurable, right? So
Mhm.
in order to increase his amount, my sister had to carry. If you don't understand the rules, basically what the carriers are looking at is a family protection plan. That's what they want to understand. Like, hey, do the parents have coverage? All right, if they do, we can extend coverage to a child. They don't really care about the living benefits that we care about. They just care about the eventual payout that they have to pay out, right? The death benefit. So what I did is I put a convertible term on my sister, who has diabetes, by the way, got her a convertible term on her in order to create a banking policy on my nephew. That banking policy will help supplement his future college, absent of Section 529 of the IRS rules. So he's not limited by restrictions. And then he'll carry that policy through college, into his marriage, and well into his retirement years. So the 529 plan, it will expire, but I was able to get that for him as banking policy by putting exactly the strategy you just mentioned, Jason,
Yep.
putting convertible term on my sister.
And it's a powerful strategy. It helps you without because now you can do exactly what you want to do with the kiddos. And if you didn't have more money earmarked to create additional banking policies for yourself or your spouse, you're able to go ahead and do that and Jeremy, for $1 million, I mean, she's pretty young, she's healthy. Women are better than we are. Sorry to say that to you. I know that hurts your feelings a little bit, but they're better. They underwrite better. But we locked it in for less than $600 a year, another $1 million of convertible term, right? That she's gonna be able to convert later. It's pretty amazing.
Yeah, when there is a point, like there is a reason that Daddy Dave says buy term, invest the rest. It's because you can, to Jason's point, have a massive protection for a short period of time at a very, very cheap cost to it.
Yeah, and the
And that,
details matter though. To Daddy Dave, I like that you brought him back. So let's round this up for folks. Jeremy, talk about why the convertibility and the details matter. Like why aren't they all equal or
yeah,
created equal?
well, not everything can be converted, you know. It's not all term policies are created equal. The only term that I ever write, it has to be convertible. We have to do that. So what you have to do, like let's say you already have term insurance and you're asking, hey, can I actually create a banking policy? Number one, it matters. Like it depends. Like I don't know. I need to see what you have.
Yeah.
I need to see who it's with, and if it's not someone that I can build with, maybe I know someone who can actually help you. But the first thing you need to do is, well, how long is your conversion window? That's the first thing I would ask is when did it start and when does the term expire? And then we need to look at who's it with. Ideally, it's with a mutual carrier so we can get a lot of the benefits. And then do you want to do a partial conversion or do you want to do a full conversion? And then some carriers will look at age limits. Maybe you can't convert after a certain age. So we want to be able to look at what's actually happening here. The way that it's structured and the way that it's designed, there, I guess the first question is when does it expire? If you really had to take two takeaways from it, when does it expire? And is it even convertible? If you just figure out those two answers to the question, like those two questions, then we're off to actually a good head start.
Yeah, and one little kind of point of warning here for anyone that's listening, thinking, "Oh, I got a term policy, and now maybe you're a little upset because you've been putting money into it for years, like Daddy Dave told you to do, and now you're like, hey, I want to do this whole life thing. I want to convert that term into a policy." Well, if you're insurable now, it might not even make sense to try to convert that, right, Jeremy? Like maybe you keep carrying it till it expires, or
It could be the gap. Yeah.
we're gonna look at the scenario like Jeremy said. Not all of them are gonna convert, depending on who wrote it in the first place. There's a lot of different things we're gonna look at, but we know this stuff, and we're gonna be able to help you navigate that.
Yeah, I think the biggest thing here, though, is really you need to give yourself a permission to start. Okay. So if I want to take away anything from here, the design that we put in place, it matters, but you may not be at a place, either you're in a transition period, you're a young builder, you may not be in a specific place where you feel as though you can financially jumpstart a banking policy. So what we want to do is lock in your insurability today. Take advantage of your health, take advantage of your age. From there, we'll end up at least creating some sort of coverage because at the end of the day, protection does matter, especially if you're a primary income earner, right? Worst case scenario, I do agree with Daddy Dave on this part is if you don't have any protection, at least go get term. Just make sure it's convertible. Get to a place in life where you can take back the banking function, implement something that you can actually build equity in and control that function in your life. So we'll gradually do conversions as your income grows. It doesn't have to be all at once. But at the worst case scenario, just go lock something in while you can, while you still have choice,
Yeah.
because that's the permission that we want. That's the thing that we want our builders to recognize is you're not behind, all right? You're not behind at all. You just need a good place to start. And you're the only one who can give yourself permission to start.
Yeah, and better than that, go ahead, and this is the most powerful thing that I'll share in any of our episodes. Pad, pick a date. Pick a date. Like if you fit any of those profiles we talked about today, whether you're like Artem and you're young and you're starting off and you're getting yourself protected, when you're in transition, like the woman from New York that's transitioning to coaching, leadership role, right? Or if you're someone that's a high net worth individual and you want to lock in your insurability, because I guarantee those people that have been doing this for 30 or 40 years, what Jeremy and I have been doing for, 5, 6, 7 years now, and have had thousands and thousands of calls, they know something because they've been through it.
Mhm.
We're
Yeah.
sharing these things. We're sharing it because you don't get to say, oops, I wish I did it then. You have to pick a date and do it. Pick a date and do it.
Yeah. So if you're sitting here wondering, like, hey, is term the right choice for me? Is it banking policy, or maybe it's a combination, maybe it's both? My encouragement to you is go to wealthwisebanking.com and just start the conversation because what might be right for one person may not be right for the other, right? Maybe we will tell you banking is a good idea for you, but it's not a good idea right now based on where you are.
Yes.
We need to get some of your habits, some of your money patterns in check. So let's go ahead and put in a convertible term policy. Maybe the two plan approach does work for you. It works for a lot of my small business owners. I love putting that in place for them. And it's not going to apply to everyone. Not everyone's a small business owner. Not everyone's a high net worth individual looking for an additional gap. For another person, it might be just reviewing what you currently have, just starting at what you already have today and seeing whether or not we can actually do some sort of conversions with it. All right. So the call really is just figuring out where you are and even if this is a good idea. I don't know if it's a good idea unless I look at your scenario.
And that's perfect because, again, term insurance, we're not Daddy Dave, but term insurance is not the destination. It's not the overall goal, but we're going to meet you, like Jeremy just said, we're going to meet you exactly where you're at. We're going to hear what your goals are, and we're going to see where you want to go. And that is going to help protect you, right? That convertible term policy is going to protect the road to get to that destination you want to go to.
Yeah. You don't have to build the whole system today. Not at all. All right. What you need to do is protect your ability to actually build that system tomorrow. That's what convertible term does. It's literally a bridge. It's a gap. That's what it is.
That's it. And if this episode made you think, good, but if it made you think about your current coverage, your health, your kids, your spouse, your future family bank that you want to build, don't leave it as a thought. Go to wealthwisebanking.com, schedule the call. We'll help you look at whether this makes sense now, whether convertible term is going to be a better first move, whether your current policy can be converted, whether you need to have that bridge next to your whole life policy, Jeremy's favorite, right? And whether your family is protected if life changes sooner than expected. So the reason to do this now is simple. You can usually adjust money later. You cannot always adjust your health later. So book the call at wealthwisebanking.com.
All right. So we'll go ahead and close things out and just remind you guys, you're already in banking.
You're just not the banker yet.
All right. We'll see you guys next week.
See you next week.
Thanks for joining us on WealthWise Banking. If today's episode inspired you, please subscribe, leave a review, and give us a like. It's a simple way to help others discover these empowering strategies and join our community. Together, we're building a network of people who believe financial freedom is within everyone's reach. Remember, financial independence is about making every dollar work for you, one step at a time. Until next time, stay inspired, stay in control, and keep building your legacy the wise way.